Welcome, everybody. Welcome to the webinar, The Future of FinTech, Regulations and Expectations, organized by the LAWASIA Banking and Finance Committee. FinTech has played a critical role in bridging the gap between the offering of traditional banks and the growing needs of customers. The financial sector globally is undergoing an unprecedented period of change, and the COVID-19 crisis is proving to be a much-needed catalyst for digital transformation. In this session, we will focus on the recent regulatory developments in the FinTech landscape in Hong Kong, India, Singapore, and Europe, and what's next on the horizon. To kick off the session, we invite Mr. Sanwon Lee, the Chief Strategy Officer of Cubital, a Series B FinTech startup in Hong Kong, to talk about the landscape in Hong Kong. Thank you, Sanwon.
Thank you, Charles. Hi. Good morning, good afternoon, good late afternoon, everybody, wherever you are across the region. Very honored to be speaking as part of this webinar. So first of all, perhaps just a brief introduction about who I am and what I do. I used to have a legal background as well. I used to work in the Hong Kong office of Clifford Chance, dealing in that capital markets work. And then around 3 to 4 years ago, I left law and joined a FinTech company here in Hong Kong. So, I sort of have this weird, unique blend of background of law, FinTech, and also business. And the company that I'm working at, Cubital, that I'm working at right now, we specialize in something called big data financing. Basically, we look at data from data of merchants from e-commerce platforms, commercial platforms, or accounting platforms, etc. And we consolidate them and we look at them together, and we assess them and give a credit limit to our clients. So essentially, we operate an online lending product platform for e-commerce merchants in Hong Kong as well as in Greater China. So today, I think I'll start off with talking a little bit about recent regulatory developments in Hong Kong, and then I'm going to focus a little bit more on virtual banks, which has been quite a hot topic since last year and this year, and how that relates to what my company does. And in the end, I'm also going to talk a little bit generally more about information in trade finance and how I think in terms of regulatory developments, it could be better to serve not just the industry, but also SMEs across the region so that they can have access to better financing. So I'm just going to do a quick share of a file. I hope everybody can see. Charles, maybe you can let me know if you can see the screen right now. Okay, great. So yeah, so just to start off with, just gonna introduce a few recent developments in Hong Kong. The first being the surge in mobile payments, and this might come as a surprise to some of the participants we have here, because mobile payments should be a very popular thing around the world right now, especially in Western countries. However, in Hong Kong, it has really been mostly cash-based transactions until recent years, and it's only been like maybe the last 2 or 3 years where mobile payment methods has really been really popular, especially after the government rolled out something called the Faster Payment System, or what we call FPS. And that is when that is basically where individuals with a bank account in Hong Kong can send money to each other as long as they're registered with the system immediately from their mobile phones. So a bit like Venmo in the United States, or Alipay in China. And of course, Alipay and WeChat has also been taking off in Hong Kong. And we also had, the government has also rolled out something called the consumption voucher scheme. So basically, everyone is entitled to a few thousand Hong Kong dollars but you can only spend it using one of the 4 designated mobile payments tools. So again, that has really encouraged Hong Kong in terms of capturing the market for these mobile payment tools. And the final point is virtual banks, as I mentioned in the beginning. So virtual banks has sort of been going hand in hand with this sort of mobile payments, digital banking kind of surge in recent years. And the Hong Kong government has licensed, given license to 8 banks in I think during 2020 to 2021, and to allow them to operate as what we call virtual banks in Hong Kong. So what that really means is they can operate without any physical branches in the city. And there are 8 in total, including some of the banks operated by Ant Financial, by Tencent Group, and also by some of the traditional banks like Bank of China, Standard Chartered, etc. And I think all of them have come into operation in the past year. So I'm going to dig into a little bit deeper into virtual banks. So if we look at the purpose of virtual banks and what the Hong Kong MA, or Monetary Authority, has to say about virtual banks, we can see sort of what is the purpose of setting this up. So first of all, in Section 3 of this guideline that was issued in 2018, the MA says, the MA welcomes the establishment of virtual banks in Hong Kong. The development of virtual banks will promote the application of financial technology and innovation in Hong Kong and offer a new kind of customer experience. In addition, virtual banks can help promote financial inclusion as they normally target the retail segment, including the small and medium-sized enterprises. So all, it's all great, right? Sounds great. Sounds like, very innovative. We are entering into a new era where, FinTech is really taking off in Hong Kong. However, if you look at the finer details in terms of how the MA is supervising and regulating these virtual banks, you will see that virtual banks are actually not very different to how traditional banks are governed in Hong Kong. So in Section 9, for example, they say virtual banks will be subject to the same set of supervisory requirements applicable to conventional banks. That said, some of these requirements will be adapted to suit the business models of virtual banks under a risk-based and technology-neutral approach, whatever that means, right? But and then in further down the section, you will see that at a minimum, the applicant must go through 8 basic types of risk identified in the risk-based supervisory framework of the MA, such as credit, interest rate, market, liquidity, etc. And something that really impacts companies like us or the industry where we're working in is how these virtual banks are able to do a credit assessment or credit approval on loans to SMEs, right? Small, medium enterprises or SMBs. And again, in a supervisory manual that was issued by the MA, which are also expected to be followed by virtual banks, you will see that virtual banks are also required to look at current credit and financial information on the borrower and relevant group members, amongst other things, right? And I think the problem with this is it really drags virtual banks back into a very traditional kind of credit framework, where basically the way virtual banks assess the loan and traditional banks assess the loan are pretty much the same. But the problem is virtual banks, I mean, in my opinion, virtual banks shouldn't really just be a digital version of a bank, right? It's not just I'm doing exactly what a bank does, but I'm doing all of that online. It should also adapt to technological advances that has happened over the years. So as you can see, the supervisory manual was published in 2001, where many of the technological or internet developments that we have today are not present. And using such a framework to apply to existing ways of lending a loan, I think it's there's a little bit of a mismatch there. So, for example, a lot of the SMEs right now, they probably don't have very good financial accounts, and that is because they operate in the e-commerce sector, where they are, with new operating services or platforms like Shopify, for example. It's very easy to set up a shop there, and there are no very stringent requirements in terms of like having to maintain proper set of financial accounts, financial statements, like we used to back in maybe 10 years or 20 years ago. And so these online shops or online merchants are also SMEs, right? They're also SMBs, and they also require financing. But because there is such a stringent framework applying to banks and virtual banks, it makes it very difficult for these merchants to obtain financing from financial institutions or banks, also virtual banks, which are under the regulatory framework of the MA. Right. So I think this creates a bit of a financing gap here. So in a little bit more detail, if we look at how this framework governs KYC, for example, that shows it's another good example of the same problem. So in section 2.4.3 of this manual, for example, it says that virtual banks or AIs offering facilities through the internet should ensure that the requirement to know their customers is strictly followed for their internet banking customers. And this is the key point. They should normally try to establish face-to-face contact with their customers. But if this is not possible, they should ensure that there are other arrangements to achieve this objective. So the emphasis here on face-to-face contact, I think, really puts some of the virtual banks into a bit of a conundrum here, because virtual banks will find it quite difficult to balance between creating a product which really has an innovative or pioneering customer experience where the customer can whether it's an individual or SME, can apply for the entire loan online, and also balancing that with complying with these regulatory requirements. And I think what we've seen so far in my experience, our experience, because we do speak to some of the virtual banks in Hong Kong as well, in terms of collaborating on giving loans to Hong Kong SMEs. We see that a lot of them are quite conservative at the moment, in the sense that they are quite cautious in terms of this completely online approach. And a lot of the times they would still require actually meeting with the borrower or the director of the borrower, etc., face to face, or visiting their office space face to face, which is even more difficult in the current COVID kind of environment around the world. So I think going back, just to recap, the issue here is that we're applying some very traditional framework that usually applies to conventional banks, but now virtual banks are actually also subject to these. So at the end of the day, we do have this innovation, digital banks, taking off in Hong Kong, but the financing gap for Hong Kong SMEs is probably still unresolved. So moving on, moving on from the virtual bank discussion, I just want to speak a little bit more about trade finance in general in Hong Kong. So if some of you are in trade finance, you will know that involves a lot of different parties, right? For example, the buyer, the seller, and also there are a bunch of logistic players in the middle, like the consignees, the freight forwarders, the warehouse provider, etc. And all of these participants are able to provide some kind of trade information, which is beneficial actually to the financing provider. Let's say if I'm providing, whether I'm a bank or a third-party provider, and providing some kind of trade finance product like an LC, for example, or simple ones like invoice discounting or invoice financing. And in fact, the company that I'm working in right now, we used to be doing a receivables financing product right at the beginning. And so all of this information is very valuable. It also helps financial institutions and banks to be able to mitigate fraud, because a lot of times, because of the fact that these data formats are pretty much not very standardized or very inconsistent. It's very easy for some of the not so good borrowers to actually conduct some kind of fraudulent activity over the banks or financial institutions by submitting false trades, for example, to obtain financing. And what the HKMA did, I think in 2017 or 2018, is that they built a platform on the blockchain called the E-Trade Connect. And as you can see on the screen here, which is a description from the official website, is a system that allows buyers and sellers to create, exchange, and confirm purchase orders and invoices in real time, and share information on a need-to-know basis, as well as submit applications for financing on one single interface. Right? So what you need to do is you will need to register with your bank, who's providing you with that financing product, and upload all your purchase orders, invoices, logistics information, etc., through your bank's portal, which is then shared with other banks in the network and other players in the network to verify that trade. And that, I think, is a great initiative because it's something that really helps mitigate the fraudulent behavior that I was talking about. But the problem is this system, despite it being very advanced and innovative, it's only limited to a number of what they call initiating or participating banks, which are the ones that you can see on the screen here. So it's only just a few about it's I think around 13 banks, yeah. And that's not a lot of banks and financial institutions. And also, it's not currently open for any third-party providers of financing products, like, for example, a company like ours or FinTechs in general in Hong Kong and across the region. So, which is a bit mind-boggling, given how innovative and how useful this initiative is. I really do think that the HKMA should really open this up to more participants across the industry, like FinTechs, like third-party providers, or money lenders, for example, who are licensed by the government to be able to participate in this scheme, and to sort of because I mean with blockchain initiatives, the more participants you have on the system, the greater the benefit it is, because the more players there are to share information. So it is a bit confusing as to why this is still currently limited to just the number of banks that you see on the screen right now, right? So this is another topic that I wanted to share about trade finance in Hong Kong and how the government is driving FinTech in this space. So that concludes my sharing for today, and hopefully you've enjoyed it, and happy to answer any questions that you may have. Thank you.
Thank you, Sanborn. For the participants, as a matter of housekeeping, feel free to type in your questions in the Q&A box at the bottom of your screen, and we would answer them during the Q&A session after all speakers speak. So next up, we have Mr. Nyong Ming, partner of Withers Worldwide. He's a partner in the corporate team at Withers.
Thank you, Charles, for the kind introduction. Hi, everyone. I would like to start by thanking LAWASIA for inviting me to speak at this webinar. My name is Ming, and I am a corporate lawyer in Withers Katawong in the Singapore office. I specialize in corporate mergers and acquisitions, capital markets, and regulatory work. and this also includes FinTech advisory and regulation. With us itself, we are a full service law firm. We have offices throughout the world, throughout Asia, Europe and London and Milan, and across several states in the US also. So for today's talk, I will be talking about the recent FinTech regulatory developments in Singapore. And because I won't have a presentation slide, I will be starting off with giving you a short structure of my talk, so you would have the context when I broach the topic. So I'll be starting off with some background and introduction to the FinTech regulatory landscape and governing authority in Singapore, together with a regulatory backdrop and approach upon which the authorities formulate regulation and legislation for FinTech. After that short introduction, I will then move on to some of the key regulatory steps taken by the Singapore government, mainly being with the passing of the Payment Services Act 2019 and the introduction of the digital bank licensing regime in Singapore in also 2019, I think, yes. So without further delay, so Singapore has been a bustling hub of FinTech activity due to its vibrant tech environment, presence of many industry players. There's also a lot of access to funding and liquidity. And most important of all, it has a very business friendly regulatory framework. The main financial regulatory body of Singapore is the Monetary Authority of Singapore, the MAS, which is also Singapore's central bank, and it is the authority which is overseeing FinTech regulation. So since a while ago, MAS has always taken a very active approach towards understanding and regulating FinTech, having recognized its potential and the digital direction that the world is moving towards. It has been very actively moving towards creating a financial ecosystem that facilitates the digitalization of Singapore's economy and development of FinTech. So in formulating regulation, MAS has always taken a very activity-based approach as opposed to a regulation-based approach. What this means is that it participates very actively in the industry itself, having a lot of communication and interaction with industry players, with industry experts. They leverage on the industry experts' knowledge and experience, and to better understand the intricacies and the challenges faced by the industry. So towards this purpose, in 2015, the MAS set up the FinTech and Innovation Group, which is a branch within the MAS itself, as its specialized FinTech office. And this serves as its primary point of coordination for FinTech related regulatory policies and to encourage and mobilize the use of tech innovations in the financial industry. So one of the key initiatives under this FinTech and Innovation Group was the introduction of the Regulatory Sandbox. So the Regulatory Sandbox was introduced by MAS in November 2016, and it was with the intention of enabling experimentation of tech innovation for financial products and services. How the sandbox actually works is that parties, anybody with or any business which has an innovative FinTech product will apply to participate in the sandbox. And if MAS assess them and admits them into this regulatory sandbox, the applicant will operate in an experimental phase, whereby certain regulatory and legal requirements that usually apply to the FinTech sector will be relaxed. So, but of course, the specific regulatory and legal requirements that will be relaxed is something that's determined by MAS on a case-by-case basis, depending on the product or the offering of the applicant itself. and the risk that arises from its activities. So throughout this entire sandbox process, the applicant will work with MES to fine-tune their product or offering and address any risks and issues faced during the experimental stage. And if it turns out to be successful, the applicants can then graduate from this sandbox, upon which any regulatory relaxation that they enjoyed during their stint in the sandbox will then be removed, and they will have to fully comply with existing regulations. But this is after the entire product has already been fine-tuned to be mature enough for the market. So the sandbox proved to be successful, and in 2019, MES then introduced a Sandbox Express, which was targeted at two specific regulated activities. One is insurance brokerage, and number two, establishing or operating an organized market, which is basically an exchange a market for the exchange of financial products. So the Sandbox Express basically came with a set of predetermined relaxations to regulations that allowed applicants to onboard faster and start market testing within 21 days from the date of application. Subsequently, in November 2021, MES then announced a Sandbox Plus, which was an enhancement where they introduced 3 enhancements to the Sandbox program, whereby they expanded the eligibility criteria to include early adopters of tech innovation, to allow more people to be able to participate in the Sandbox program itself. And they also streamlined the applications with financial grants. So the MES actually has has introduced a lot of grants and a lot of subsidies for participants in the industry, and with the Sandbox Plus, applicants who actually applied to it will be introduced immediately to these financial grants, and MES will automatically be able to assess them on their suitability for these grants. And lastly was participation in Deal Fridays. Deal Fridays is an initiative which allowed, which basically connected innovators or innovators in the fintech industry with potential investors to see whether investors could basically find, or basically for innovators to see whether they could find funding during these Deal Friday sessions. So that was a snapshot of the kind of approach that MES takes towards formulating regulation. As you can see, it's a very active, participatory-based type of approach that they have taken, so that by the time regulations are introduced, the MES already has a very deep understanding of the industry itself. With that, I think I will then move on to the main body of my presentation itself, starting with the introduction of the Payment Services Act 2019. So the Payment Services Act, or the PSA, was passed by Singapore Parliament in 2019 and came into force on the 28th of January 2020. It was mainly to address 4 key risks. Number 1, money laundering and terrorism financing. Number 2, loss of funds owed to consumers or merchants due to insolvency. Number 3, fragmentation and limitations to interoperability, which is basically the exchange of information between systems, cyber systems and online systems. And number 4, technology and cyber risks. So it's in this context that the PSA was introduced. So the basic framework of the PSA was that it stipulated 7 regulated activities with which, if anybody who's carrying out these activities, will require the prior approval and licensing of the MES itself. Number one is the activity of account issuance, which is e-wallets, including certain multi-purpose stored value cards or non-bank issued credit cards. Second one is domestic money transfers, such as payment gateway services, payment kiosk services, or other local fund transfers that doesn't involve a financial institution. The third is cross-border money transfers, such as remittance agents. The fourth, merchant acquisitions, which is a service of providing payment transactions from or payment receipts on behalf of merchants, providing point of sale terminals like your credit card, your card machines, payment machines, and all that, or any online payment gateways. The fifth regulated activity is the electronic money issuance, which is the services of issuing e-money to allow users to pay merchants or transfer funds to another person online. The sixth and the most interesting one is digital payment token services, which primarily consists of cryptocurrencies. So basically payment token services which are not a capital markets product under the Securities and Futures Act, or any services that provides a platform to allow the exchange of digital payment tokens. And lastly, not so relevant to this is the money changing service, which was previously under the Money Changers and Remittance Business Act, but that was then repealed and consolidated under the Payment Services Act. So applicants can apply to for license under the Payment Services Act, primarily for two licenses. One is the Major Payments Institution license, and the other one is the Standard Payment Institution license. The difference between the two is that the Major Payment Institution license has a higher threshold, whereby if the monthly transaction for one regulated activity exceeds 3 million, or two or more regulated activities exceeds 6 million, then you will, on a monthly basis, then you will need to apply for Major Payment Institution license. Whereas anything that falls below that threshold, you will then apply for a Standard Payment Institution license. And MAS has actually granted quite a few licenses under the Payment Services Act since its introduction. So some other requirements to be granted the license under the PSA. One, the applicant must be a company. Number two, they need to have a permanent place of business or a registered office in Singapore. And last, number three, at least one director who is a Singapore citizen or PR. So changes to the PSA. So even though the PSA only came into force in 2020, which is 2 years ago, the MAS recognized that the fintech landscape is a very fast evolving one and has always been very keenly observing the changes that are taking place in the industry to ensure that legislation is never too far behind with industry developments. As a result, the Payment Services Amendment Bill 2021 was passed by Parliament on the 4th of January last year to more comprehensively address risks relating to, firstly, digital payment token services, second, cross-border money transfer services, and lastly, anti-money laundering and counter-terrorist financing. So prior to this amendment, the PSA only covered activities relating to the buying and selling of digital payment tokens or cryptocurrencies or exchanges which facilitate the buying and selling of it. But under the Amendment Act, this scope was actually expanded to also cover services to transfer or facilitate the transmission of payment tokens from one token account to another, whether within Singapore or whether it's a cross-border transaction. Number two, it also was expanded to also include services to provide custodial wallet services for payment tokens, such as Hold Not, where you can use them to hold cryptocurrencies. And lastly, the facilitating the exchange of payment tokens without actual possession of tokens or money, such as marketing and advertising of payment tokens. So, so even though it's a relatively new act, it has actually seen a lot of development in the short time since its introduction to basically keep up with market developments. So if I could then I think that's more of like that's a summary of the Payment Services Act. If I could then quickly move on to the next topic, which is the introduction of the digital banking license regime. So MAS announced in June 2019 that it will be issuing licenses for digital full banks, up to 2 digital full banks and 3 digital wholesale banks. And these licenses are actually in addition to any digital banks that the Singapore banking groups have already established under the existing internet banking framework. The introduction therefore meant that digital banks were now extended to non-traditional bank players. The characteristics of digital banks under this regime is that they are only allowed to have 1 physical place of business. They will have no physical branches, no ATMs, and no cash deposit machines. All services will be done online. And I think MAS basically introduced it. The introduction was motivated by MAS's recognition that the banking landscape is undergoing a fundamental transformation, driven by a lot of pervasive access to mobile internet, the rise of big data, and the growth of platform ecosystems as a major new business model in finance. And it was basically a step towards making sure that Singapore retains its position as one of the leading financial centers in Asia, to allow for greater competition in the sector. So following MAS's announcement in 2019, at the end of 2020, MAS announced 4 successful candidates to obtain the licenses. For the digital full bank license, it was awarded. The first one was awarded to a consortium of Grab and Singtel. The second one was a wholly owned entity of C Limited. For the digital wholesale bank, the first license was issued to a consortium of Greenland Financial Holdings Group, Link Hong Kong, and Beijing Cooperative Equity Investment. The second one was a wholly owned entity of the Ant Group. The difference between a digital full bank and a digital wholesale bank is that digital full bank is essentially supposed to be the same. They are essentially supposed to offer the same services and offerings of a traditional bank, whereas a digital wholesale bank is meant more for non-retail customers, such as businesses and corporations. And aside from that, all the digital banks will all be required to fully comply with the Banking Act 1970, similar to all other traditional banks. So that is a summary basically of digital banks in Singapore. Before I close off with my conclusion, another very quick update is a regulatory update is MAS's latest guidelines on the provision of digital token services to the public, which was issued only in January this year. Basically, MAS has always taken the position that cryptocurrencies is a very high-risk investment and is not suitable for the general public. So in the latest guidelines that were issued, basically it provided that digital payment token service providers should not be promoting their services to the general public in Singapore, and should conduct themselves with the understanding that it is not suitable for general public. This meant that they could not promote their services in public areas or through any other media directed at the general public. They can still, however, promote services on their own websites, mobile apps, or official social media accounts. So in conclusion, for Singapore, I think we can expect to see further amendments to FinTech legislation in Singapore, further amendments and introductions to FinTech legislation in Singapore in the next 1 to 2 years, as the industry evolves and regulators pay attention to not just industry trends, but regulatory focuses in other jurisdictions like the US and Europe. And I think one area which is likely to see regulation is stablecoin, which has been gaining a lot of attention lately. The current definition of the digital payment tokens under the PSA still excludes tokens which are pegged to a currency, such as stable coins. But given this widespread application and the use of stable coins, I think we're likely to see it being regulated in the near future. So that concludes my presentation for Singapore. Thank you very much.
You're on mute.
I'm sorry. Thank you, Chong. We have a question on the QA. Could you, Chong, answer this question? How many digital banks in total in Singapore, besides the existing 4 new DBS, including Grab and DBS?
Pure digital banks, there are only 4 at the moment. The other traditional banks in Singapore, they all have like a digital arm to it, which allows internet banking. So but pure digital banks for now, licenses have been granted to 4 of them. But to my understanding, they are not operational yet. They're expected to be operational within this year.
Okay, thank you. Okay, let's go to the next panelist. I would like to introduce the Mr. Adiam Mukherjee. Is it correct? My pronunciation. So Adiam is a partner in the dispute resolution practice of Veras. Adiam specializes in civil, commercial, and constitutional litigation and advises clients in a variety of matters, including commercial disputes, monetary suits, and declaratory actions. He also advises mobile payment, prepaid payment instruments, and payment gateway companies on operational modeling to ensure compliance with regulations governing payments and settlement systems in India. Okay.
Thank you.
Please.
Thank you, Yuri, for that introduction. Hi, everyone. I have already been introduced, so I don't need to really take any time in introducing myself. And I would like to start by thanking LAWASIA for inviting me for this wonderful webinar. I'll dive right away. I have a short presentation, so I'll just start with that. I hope the presentation is on the screen and everybody can see it. Okay, so talking about the FinTech landscape in India, that's where I'll start from. You know, most of the FinTech developments that have taken place in India are around financial services. So they are mostly in the area of payments between individuals and payment between in e-commerce, lending, investing, and banking services. The way we have always defined, you know, FinTech developments is primarily, it is a digital and app-based delivery model which enables technology-enabled innovation in financial services and resulting in new business models, applications, processes, or products which are associated with such services. The main reason why FinTech has developed so much in India over the last couple of years is because of the reach of wireless internet services. And when I say wireless internet services, it basically means the kind of services that are available to people with smartphones. So these are figures from the 30th of November last year. 770 million people approximately have access to wireless internet, and that creates a great ecosystem for fintech development in India. So next, coming to, how did fintech change and change things in India? So, I have listed out a few of the sectors where fintech has considerably changed the Indian landscape, but there are more, and some of them, banking services. We know how internet banking, mobile banking has become the norm now. People don't generally visit a bank anymore in India to carry out their banking transactions. From transferring payments, transferring money, to all kinds of services are now available through development of fintech in the banking services sector. Settlement services mostly between large corporations, between individuals. A lot of technology has come here, and this technology driven there are a lot of innovations where payments can now actually happen from one individual to another, one company to another, one individual to the government on a real-time basis. And there's a lot of development which has basically come from fintech players in India in this space. There are other developments that have taken place in fintech, like for lending and capital raising services. These are mostly traditionally people needed to approach banks for lending purposes, but now there are a lot of other forms of lending that have come in, including peer-to-peer lending, and this is all regulated, but the technology has primarily been put in place by a lot of financial technology development that has taken place over the last couple of years. Securities trading is one area where a lot of financial technology innovations have taken place. All scripts, shares, debentures, they are all on in dematerialized form now in India, and this is again one of the something that financial technology and innovation in the sector has made it possible. Lastly, web-based aggregators. Everything in India today, from shopping to taking rides on Ubers, everything, payments can also be made other than the traditional modes of payments, which were things like credit cards. Today payments can be made through virtual wallets, through the unified payment interface that has been created. And so there's a lot of technology driven development when it comes to web-based aggregators and the services they provide. Now, the regulatory framework in India is very interesting. It's very interesting because the law that regulates most fintech activities in India was something that was enacted in the year 2007, and today we are in 2022. So that's about 15 years. The law has hardly changed, but because the law provides for a lot of scope for oversight as a regulator to the Central Bank of India, which is the Reserve Bank of India. The Reserve Bank of India from time to time has been making changes through instructions which are in the form of notifications, etc., so that the sector keeps on moving. The only relevant and I think all encompassing definition that's available within the law is what is a payment system. And if you see the definition, and I put it on the presentation here, it means a system that enables payment to be effected between a payer and a beneficiary. And then if you see, it involves a whole host of services, it kind of includes a lot of things. And that is what the regulator, the Reserve Bank of India, which is the primary regulator of most fintech driven sectors in India, has actually used, and it continues to use on a daily basis, monitoring whatever developments are required, whatever issues need to be addressed, and they go ahead and do that. And sometimes foreign lawyers tell us it's impossible to understand. So many notifications keep coming out every day. There is something new, and we keep telling them the reason for that is because of this all-encompassing power that is given by the Payment and Settlement System Act, which was enacted in 2007 to RBI to ensure that anything that is required in the fintech sector is addressed by it. There are some other provisions. Also, these are provisions, again, like I mentioned, these again provide a lot of oversight on all kinds of activities that encompasses fintech activities in India. So, there are provisions in the Act where the Reserve Bank of India is the central bank is given powers to make regulations, and they have over the years made 2 such regulations, which are the Payment and Settlement Systems Regulation and the Board of Regulation and Supervision of Payment and Settlement Systems. So these are the 2 main regulations that help in RBI coming up with different notifications, instructions, so that the sector does not, the sector can keep progressing. There are a lot of other developments that have taken place over the years, which have ensured that some other regulations are put in place, but mind it, these are all regulations that are mostly given out by the Reserve Bank of India again. And like I mentioned, the peer-to-peer lending platform directions, which were issued in 2017. Recently, the unified payment interface, which is one of the greatest fintech innovations that has taken place over the last couple of years. So there are some procedural guidelines on how this whole UPI framework has been put in place. And so then there are non-banking financial institutions, which are also again governed by the Reserve Bank of India. Amongst all of these, there was this whole experiment, so to say, that the Reserve Bank of India started doing a couple of years ago, mainly so that financial inclusion could take place in India. And they started allowing lot of telecom companies to partner with traditional banks and provide banking services. So these payment banks, they were called payment banks, and these banks have over the years developed and are providing a lot of services. One of the best examples of a payment bank is Paytm, which was one of the unicorns which recently concluded initial public offering in India. Now we have the Reserve Bank of India, which has been regulating the whole fintech sector, so to speak. However, there are times when the Reserve Bank of India has also had to go ahead and take decisions, which have, sometimes created a little bit of uproar in the fintech space in India. One such decision that the Reserve Bank of India took last year was something that is called tokenization. Now, what the Reserve Bank of India tried to implement was that whenever a person in India makes a payment through a credit card or a debit card, or any kind of transaction online with a card, they wanted this information to be transmitted in a manner so that if there were data leaks in the future, the real information of the customer who was trying to make the payment would not leak out to in such data breaches. This required a lot of integration of systems, change in hardware and software setups, and there were a lot of incidents where some of the biggest card acquirers like MasterCard and Visa were not very happy with this requirement as was put by the Reserve Bank of India. As a matter of fact, there was a time when a lot of institutions were not able to put this in place, so much so that in April 2021, American Express and Diners Club were reprimanded by the Reserve Bank of India for not implementing these norms. The second norm that had also been put in place was a norm which required data localization. Now, along with tokenization, what the Reserve Bank of India has been trying to do here is to try and ensure that data that is fed into the system when transactions are processed, that data does not leave India. This also required considerable investment as well as IT infrastructure within the Indian jurisdiction. So there was a lot of hue and cry about this. There were protests that it would be very difficult to do it. There were institutions like MasterCard which said that we monitor fraudulent transactions from one particular jurisdiction, which makes it easier for us to compile data, do analysis, do research, and take corrective measure. But the RBI still said that Indian transactions would have to ensure that all the information that is fed into the system is maintained in India, so that whenever the Reserve Bank of India or its officials wanted to do system audits, this information would be readily available. There were a lot of changes. There was a lot of to and fro between all the institutions providing such services and the Reserve Bank of India, and finally most of the institutions have implemented this. So that was the broad framework under which mostly as on date the FinTech institutions, companies actually operate. So oversight is provided by the Reserve Bank of India. The Reserve Bank of India completely from granting licenses to carrying out audits, undertakes all activities so that it's a regulated industry and it carries on like that, and it also takes care of its development. Now, I generally been seeing a lot of buzz around crypto and what is India doing about crypto. Now, just to take you all back into history, sometime in the year 2018, the Reserve Bank of India, again being the central bank, put a blanket ban on cryptocurrencies. Now, how did the Reserve Bank of India do that? The Reserve Bank of India gave an instruction to all banking institutions in India who are granted license by the Reserve Bank to not allow any person to deal with these banks who were offering services related to cryptocurrencies or customers who were dealing with cryptocurrencies. Immediately, as in India, the instructions issued by the Reserve Bank of India was challenged before the Supreme Court of India. The Supreme Court of India heard all parties, and in 2020, it gave out a landmark judgment, so to say, where it said that this instruction of the Reserve Bank of India to all its licensed banks was not proportionate to the issue at hand, and it struck down this instruction. Now, interestingly, the government of India or the Reserve Bank of India has not done anything since about bringing about any legislation to regulate cryptocurrencies or any kind of instructions as to whether people can invest in cryptocurrencies, etc. There were certain banks which were still not providing services to people dealing with cryptocurrencies. Recently, the RBI has clarified that its previous instruction issued in the year 2018 has been struck down by the highest court in India. So therefore, banks cannot deny services to people dealing in cryptocurrencies. However, there's a very interesting thing that the RBI also said in the same instruction. And the RBI said that there is always a potential danger in dealing with cryptocurrencies in India. And therefore, banks would have to stringently ensure that, know your customer, which basically means authenticating customers when who are availing services from bank, money laundering laws, laws on combating of financing of terrorism, and all other regulations which have to be stringently followed when dealing with people who are dealing in cryptocurrencies. So in a way, there are a lot of other regulations that the RBI has already made them applicable on cryptocurrencies, but unfortunately till date we don't have a legislation which talks about how to deal with cryptocurrencies or how cryptocurrencies are to be regulated in India. Interestingly, if going by the history, the government of India, the central bank were trying to ban cryptocurrencies at one point of time. However, a lot of things have changed since. If the government of the Reserve Bank of India as well as the government of India have time and again said that they want to harness blockchain technology towards ensuring efficiency in financial inclusion and delivery programs of the government itself. They have also said that there is a law that the Indian Parliament plans to deliberate upon and pass in the future. From the little information available in the about it, the law is supposed to be called the Cryptocurrency and Regulation of Official Digital Currency Bill 2021. Now, this is a very important aspect because the same government of India and the Reserve Bank of India is also thinking of coming up with the first of, or is also planning to introduce the first central bank digital currency in India. So therefore, they have named the law when it comes also talks about the official digital currency. So that India will probably in the future have an official digital currency also. Now, I have generally tried to give you a broad overview of how the FinTech sector is generally regulated in India. So the Reserve Bank of India regulates the FinTech space on a very close watch basis. There are several instructions which keep coming time and again to ensure that the sector develops, as well as there are regulations so that nothing illegal takes place in India. Like Singapore, in India also there are a lot of sandbox ecosystems that are being created by the Reserve Bank of India. As we speak, India is already testing technology where real-time transactions can also take place without internet mobility, without the availability of the internet. So these are all projects that are taking place. So RBI has generally done a good job when it comes to regulating the FinTech space. However, again, the law is quite old. It's a 2007 law. We are in 2022. So there's a lot of things that have changed in the landscape over the last 15 years. And it may be a great idea to, introduce an updated law which will not require the regulators to keep on providing instructions. Instead, a law can come about which will have most of the learning that we have achieved over the last 15 years embedded into it, so that the way the FinTech sector works, confusion, etc., can be avoided. The way forward would also require, FinTech is generally expanding its base. It's moving on to other sectors which were traditionally not part of the sector. Traditionally, it was only a payment-based sector, but now FinTech is also regulating, the capital markets in India. FinTech is also getting into the insurance sector, and FinTech with payment systems being provided by a lot of information technology-based companies. There is also the Ministry of Information, the Ministry of Electronics and Information Technology of the Government of India, which has gotten involved. So there is a need in the future for some kind of a bridge between different regulators in India, the central bank, the Securities Exchange Board of India, which regulates the capital markets, the Insurance Regulatory Development Authority, which takes care of the insurance sector, and other ministries within the government. So that's my take on the topic presented to me today. If there are any questions, please feel free to let me know.
Thank you, Adiam. Any questions from the audience? If you have some questions, please go to the Q&A. Okay, so there I would like to introduce the last panelist from Europe, Ms. Joanna Babla-Caviet. Joanna is a partner at Wallace, a boutique law firm. Joanna has over 18 years of experience in the field of banking and finance, including landmark financial transactions, regulatory and compliance, capital markets, funds, and fintech work. So Joanna, please proceed.
Thank you, Yuri. Hello, everyone. It's still an early morning in Europe, and I hope I'm not the only one from this part of the world. So Yuri has already kind of introduced myself. I'm mostly working in financial services, and in the past few years, I'm focusing on FinTech, and there's a reason for that. Today, I wanted to share with you the story how Lithuania became the #1 FinTech hub in Europe. and how does that look in the wider context of European regulation and trends. So perhaps I should start with a few words about the market itself. So 2021 was really a record year for the European fintech market. Europe is attractive both for fintech companies and venture capital. Last year was the record year in terms of funding number of unicorns. We have 45 of them now in Europe. There were also a few attempts of the IPOs. The growth was mainly in payments, digital banking, transactional banking, but we also expect some further development of wealth tech and of course crypto. So in this context, in Lithuania, the Bank of Lithuania, which is the main regulator, has now issued 141 payment services providers license. So just to give you some context, in Estonia, which is a neighboring country to Lithuania, there are only 2 licenses. Also, in the past few years, the Bank of Lithuania and the European Central Bank has issued 9 bank licenses, which is quite a high number if we compare to the rest of the EU. So that makes us the #1 fintech hub. And of course, there were some important kind of preconditions for this success story. So by way of a background, in Europe, I have to mention that we have this dual system. So most of financial services, they are harmonized across the EU, with some exceptions like consumer finance. But the essence of financial services regulation is the so-called passporting rights. That means that you have to establish in one member state, you have to set up a company there and obtain a license. But once you do that, and once you are ready for the operations, you can passport your activities across the entire European Economic Area, which is 27 countries plus 3 more. So this European regime is very favorable for the companies because you don't have to apply for a license in each and every member state, but you can choose just one as your home member state. So the choice of the jurisdiction where to establish is actually the first question that companies that consider European expansion have to answer. And what we see from the companies, they usually kind of use a set of criteria when selecting a jurisdiction, and that oftenly includes regulatory environment, speed to market, cost efficiency, of course, existing infrastructure and ecosystem, as well as local legal requirements. And most of fintech companies, they found all these criteria appealing in Lithuania. And in addition to that, there was also, of course, one important external factor, which is Brexit. So before Brexit, obviously the UK was the leader in this area. But due to Brexit, the companies, they need to find their second home. They are kind of European base somewhere in the continental Europe to be able to continue their business post Brexit. So that I think contributed a lot, and Lithuania was kind of just in time and in the right place with its ambition to create a fintech hub. So what we did, well, you know, being a small country, we had to invent something that others did not offer. And I think that those efforts, they mainly comprised of, first of all, perhaps a general proactive approach. So there were very focused joint efforts from both the regulators, the legislators, the Ministry of Finance, also the investment promotion agencies, and also the private sector. Also, the regulator has changed its approach from being a closed and remote one. They became an open one. The essence of this was basically that they were open for pre-application meetings, some consultations and things like that. So basically they became approachable. And also all these kind of soft factors, they were contributed by some legislative efforts. So for example, in Lithuania, a concept of the so-called small bank was introduced. And just listening to the other speakers, I think that it very much resembles the digital banking or virtual bank concept that is elsewhere. Basically, a small bank, as we call it in Lithuania, is pretty much the same as a normal bank, except that it requires lower initial capital to start the banking business. Another example was the national crowdfunding regulation. Lithuania had introduced it way before the European framework came in. And well, the European regulation is effective from November last year. And in Lithuania, we already have crowdfunding platforms that are established and ready for the European expansion after this European regulation comes in. So basically what they will do, they will now passport their activities across the EU. So also perhaps to mention amongst the legislative initiatives was a remote KYC possibility, which was not existent before, but basically was introduced as a measure to make the regulatory kind of landscape more attractive to fintech companies. Also, in addition to this regulatory initiatives, what the central bank did, they have allowed non-banking institutions to access their payment system. So basically, in Lithuania, non-banking payment services providers, they can access SEPA area via the infrastructure of the Bank of Lithuania. And most of the fintech companies, they found this very appealing because this is not something that other European jurisdictions were kind of willing to offer. And of course, in addition to that, there were perhaps cost efficiency factors and the ecosystem itself, well, that basically was a pool of talents, availability of the service providers and office space providers and things like that. So you may think what's in it for the country, and I think there's a huge benefit for the country because well, we can speak about jobs created directly in fintech companies, and not only in fintech companies, but also in other supporting areas like accounting firm, legal firms, IT development, and alike. But also, I think one of the most important achievements is that well, Lithuania was got known in the fintech area, and this is really something for a small country like us. So now, since we are clearly on the top, I think most people, they have a question for how long it is going to last and whether Lithuania will be able to maintain its position going forward. And I think that is quite a difficult question. And the answer perhaps is that it depends. Again, I think it depends on the joint efforts. Well, the regulators, they have to maintain the trust, while the market participants, they have to ensure compliance. and some of them, they struggle a little bit to keep up to the standards. So this number one position is perhaps not for granted, and the risks will have to be managed. I think the general trend on the European level and also on the national level is that there will be just more regulation to come. And well, naturally, we are all expecting European regulation of crypto activities, and it's about to come in perhaps a few years timeline. There are also kind of national initiatives to regulate FinTech, crypto activities even before that. Also, we expect some changes in the AML area, mostly again related to crypto activities. Also, there is a European proposal for the Digital Resilience Act. Also review of MiFID, which is basically related to investment services, but that is also very much relevant to wealth tech development. On top of that, I would say that there is a clear trend that in addition to the financial services regulation, we have screening of investors for the compliance with the interests of national security. We have that in Lithuania, but as far as I've heard, these kind of regimes are also kind of introduced in other countries as well. And that's perhaps a concern, especially in nowadays reality. Also, what is perhaps specific to us and to our region is that we see some new regulations, which is basically a response to the current Russia's invasion of Ukraine. And well, one of the examples is that the Bank of Lithuania has basically recommended to suspend all the payments activities of Russian clients. So that's the latest development, and we'll have to see how it evolves. So the future is a little bit uncertain, but we do hope for the best. We hope that we will successfully adapt to the new kind of realities and to the new challenges and to the new regulations. And that basically concludes my sharing for today, and I'm happy to take questions.
Thank you very much, Joanna. So for the audience, please go to Q&A if you have any questions. And otherwise, we have received the questions in advance to this seminar, so I'd like to introduce some of them. I think in relation to the Joanna's presentation, the questions is probably relevant to that presentation. It says that why cryptocurrency cannot be legally regulated as it may be used for terrorist funding, and that is crime against humanity. Why fraudulent transactions of public money in cryptocurrency violating human rights of public cannot be restricted. Unregulated transactions by cryptocurrency may lead to exploitation of humanity in developing economies. We can be restricted. And if you have any thoughts, Joanna, can you tell us your thoughts? If
sure,
you have.
I think I can start, and maybe others will be happy to join. So I think the point is that at least in the EU, we are clearly going towards regulation of crypto activities. In most of the European countries, it's now not really regulated and not subject to authorization, but it's not prohibited. So the crypto companies, they do set up here and they start their activities. But everyone is looking for this regulation really to come in and to kind of clearly define the rules of the game, so that it's on the one hand it's secure, and for the companies it gives clarity as to what is permitted and what is not. And as I mentioned, there is a European kind of proposal for this regulatory framework. In a nutshell, I would say that it very much resembles investment services regulation, and perhaps in the near future, we will see crypto activities regulated in a similar way as we currently have investment services regulated.
Thank you. In my understanding, so the crypto or currencies overall, some jurisdictions have already the regulations, but some jurisdictions have not yet have the regulation. So let's see what is going on in the near future. And one more question about the in relation to the crypto. The regulation of the environmental threat of cryptocurrency and blockchain technologies. I ask all of your panelists if you have any thoughts on this. I think this question is related to the environment threat, means that especially in the mining activities, because that its consumptions are huge power volume. So if you have any thoughts, do you have any, the panelists? Okay, again, I would like to ask Joanna, because that I read the article about the European Parliament's the vote for the markets in crypto assets bill, MICA, and beforehand there was a discussion about the due to the climate change, the carbonization, that there was an idea to ban the dealing with the crypto, but in fact that kind of the idea was avoided. Do you have any thought on that?
Well, to be honest, that's perhaps more for environmental lawyers to comment. I'm more focused on financial services regulation, but I think, you know, the environmental aspect is of course one thing, but irrespectively of whether it's regulated or not, I think crypto is there and all the environmental issues are there. So what the regulation is actually aimed at is at making this service kind of secure from the financial services and risks point of view. So I think that's the core idea of MiCA, and the environmental issues are left a little bit aside, I would say.
Okay, thank you. And we have also the two questions. One is how can legislation be used to assess the growth of FinTech in the country rather than harm its development? Is there anyone who volunteers to answer the question from the panelists? Oh, how about Charles? Do you have any idea about the first question we have?
I think, I mean, legislation itself depends a lot on what the people need, and often I think the thing is, from a regulator perspective, its foremost role is to protect the general public. Obviously, it's how to draw the line between the protection and hampering the growth. That's always a difficult question, I think. Actually, I think time is running out, but we have one last question from the chat. I think that would be for Chong Ming. I think that would be. How is the risk to the financial system from participants in the sandbox managed by Singapore?
Well, the participants to the regulatory sandbox are closely monitored by the MAS, and they have constant communication and liaison with the MAS So it is only during their sandbox period that the certain rules and regulations are relaxed, and even then these rules which are relaxed are very carefully selected by the MAS. But the moment they do graduate from the sandbox itself, they will be subject to the full full compliance with all the rules that usually apply to industry players in the financial sector. So MAS basically controls the risk by having very close oversight over the activities of these participants.
Okay, thank you, Chong. Thank you, everyone. I think that brings us to the end of this session with exactly on the dot. And yeah, I would thank everyone for joining today and for all our panelists for speaking. And thank you for LAWASIA for the organization. Thank you very much.
Thank you. Thank you very much.
Thank you, everyone.
Thank you. Have a good day.
Bye.
Thank you.